Good afternoon. It's Jeffrey Christian of CPM Group. It's about 4:20 in the afternoon on Monday, the 9th of June. I'm recording this now for release on Tuesday, the 10th of June, because I'll be out of the office Tuesday morning. I want to talk about platinum, and there are two sets of issues that I want to focus on. One is the current situation. The price of platinum has risen a couple $100 over the last 2 or 3 trading days. And I want to talk about some of the factors that are beyond that so that we have some idea of where we might expect the platinum price to go. Then I also want to talk about this longer-term conundrum that exists in the platinum market. We have a lot of institutional investors and high net worth individual investors and others who ask us about why the platinum price has been trading the way it has between, say, $850 and $1,100, $1,200 for the most part, since 2014, when there are stories out there that the platinum market should be much tighter and in an ongoing deficit, and the price should be higher. And I'll talk about that too. Let's first talk about the near-term conditions. Platinum prices, as I was preparing to record this, were around $1,220 for the NYMEX July futures contract. You can see here the price was below $1,100 just 3 days ago, 2 days ago. It has shot up over the last 2 days, and this only goes through July 6th. We didn't update it. It's over $1,200 today. You can see that that is above the range that has held since the beginning of 2024. Since the beginning of 2024, over the last 15 months, what we have seen is the price of platinum trading between $875 on the low end and about $1,100 last year in the second quarter on the high end. It has now broken above that. The chart on the right will show you that really since 2015, when the price came down from $1,300 to $800, the price has basically been trading in that range, $800, $900 on the low end, $1,100, $1,150 on the high end. It did spike up to around $1,300 in early 2021, but it came back down to $900 within about 6 months. So the price is testing the high end of that range right now. And I guess looking at the current market, we see 4 factors that really seem to be behind the increase in prices over the last 3 days. And understanding those factors will give us some idea of where the price may go beyond the next 3 days. The first thing is, I think a lot of market participants, especially investors, mistakenly believe the platinum market has been and continues to be in this massive long-term supply deficit. Marketing groups keep talking about that, and they have been for years. Talk about that in the longer-term section, but platinum's not in a deficit, and there's no short supply of refined platinum available to meet demand. So there's this misconception that the platinum market is really tight for supply, and producers and refiners, scrap refiners, can't keep up with supply demand, and therefore the price should be much higher, but for some strange, inexplicable reason, it isn't. And it actually is a very explicable reason. It is that the platinum market is not in a deficit, and it is well supplied. Second thing is, we've heard stories recently about how Chinese demand for platinum jewelry has risen sharply over the last couple years, last year and into this year, partly as a substitution away from gold jewelry, which is much higher. Platinum jewelry has risen in China. I'll show you some data in a second, but it hasn't been all that fabulously strong. It has contributed to some tightening in the market over the course of last year, but the surplus that we see did fall in 2024, not because of higher jewelry demand so much as because South African and other mine production was declining. The third, perhaps, misconception, it's too early to tell, is that financial markets, investors, speculators, and others have gotten enthusiastic that platinum demand in the auto industry will rise because the US and China and the world economies are avoiding a recession, and therefore there'll be a revival in auto production and sales, consequently leading to greater demand for platinum, palladium, and rhodium in auto catalysts. It's too early to say if we have avoided a recession. CPM Group still is of the view that we will see a recession second half of this year into next year. There are any number of factors supporting that contention, but there are some strong figures in demand and overall economic conditions. I have seen other projections that are still supportive of the prospects for a recession over the next 18 months. And I've seen other people economists who have been pivoting from saying that there was a recession that was likely to saying maybe we'll avoid a recession. We have seen strong demand for autos March and April. Part of that had to do with people buying cars in the United States before sanctions raised the prices. And the fourth factor is the mechanical, just the July NYMEX platinum market. Now, I mentioned this in our Friday video. This is NYMEX platinum futures. The July futures open interest as of last Thursday, the 5th of June. The July is an active contract. There were 72,000 contracts of open interest in the July contract, representing 3.6 million ounces of platinum. Inventories, the registered inventories are around 233,000 ounces. There's another 120,000 ounces ineligible. So there's about 353,000 ounces of total inventories that's deliverable to the NYMEX contract that is stored in NYMEX registered depositories. A little bit of a tightness there. That may be a factor in helping the price rise over the last 2-3 days. And this is jewelry demand. This is global jewelry demand. We do have a breakout for Chinese demand. It'll be in our Platinum Yearbook probably, which will be coming out at the end of July. We're working on that right now. And I should say that the data that we have that I'm presenting today is all subject to revisions over the next couple months and going forward as we work on the Platinum Yearbook and come to terms with our final estimates, current period estimates for 2024 and projections for 2025. The World Platinum Investment Council estimates that platinum jewelry on a global basis, most of which is in China, by the way, rose about 159,000 ounces last year, about an 8.6% increase. That's a substantial increase, and it definitely contributed to a tightening of the supply-demand balance, which I'll show you when we get into the longer-term issues. Our estimate is that it was much lower, maybe a ton. So 32,000 ounces, about a 2% change. But the reality is that even if it's 160,000 ounces, that's a substantial increase, and it would have significantly reduced the surpluses that we project for the market there. The other factor I mentioned is auto production and sales. These are data for auto sales in the United States and in China. And this is from our Precious Metals Advisory. The June issue came out last week. And the green one on the left is U.S. Sales. We have data through March. You might be able to see there's a green line that is slightly larger than a darker green line. The lighter green line represents first quarter sales of light-duty vehicles in the United States this year, and it was up slightly from where it had been in the same period last year. Not a very sharp increase, even though we did see a big surge in sales in March of people buying cars and trucks in advance of any sharp increases in the prices of these vehicles due to the proposed sanctions that Trump's been talking about since the election. On the right, you have Chinese sales, and China is now a larger market for automobiles, light-duty vehicles, than it is the United States. And you can see there it's a little bit more distinguishable. It's similarly a modest increase in first quarter. This actually goes through April, the Chinese data. A slightly better increase in first quarter, first 4 months of the year relative to last year. So you are seeing some increased demand for vehicles. It's not necessarily being reflected in increased demand for platinum, palladium, and rhodium, because you're also seeing, and especially in China, where half the vehicles now being bought are electric vehicles, they don't use platinum, palladium, and rhodium. So it's not particularly bullish for PGMs that you see the state of the auto production and sales in the largest two markets for automobiles. Now, turning to the longer term issues, we think that a lot of platinum market participants that we know and that we meet have experienced and expressed long-term disappointment because they think the prices of platinum should be much higher, because they've been working under this false narrative that the platinum market's in a long-term deficit. If there are such large ongoing deficits year in, year out, since 2015 or so, why are platinum prices so low? And our response is that's because the market's not in a deficit. This is a marketing artifice that was rolled out 2014, 2015. Oh, you should be buying platinum as an investor because the market is in this long-term deficit and prices can only rise. We can't continue to produce enough platinum at these prices. The market's not in short supply, and the price reflects those realities. If you're looking at a market and you're looking at a price for platinum, and you're saying, well, the price is probably more accurate than the supply-demand estimates, especially if the supply-demand estimates are coming from a group that's charged with stimulating investment demand for platinum. No offense. The market's not in short supply. The price tells you the market's not in short supply. If the market were in short supply, the price would be higher. The fact that the price is not higher suggests that the market is not in short supply. Now, we've been doing this work since the late 1970s, and we have data going back through 1976 for our supply-demand balances. And we do Commodities 101 basic research, and we look at total supply, iron production and refined from scrap, less fabrication demand. And if you look at the platinum market that way, you find that in all but 7 years since 1976, the platinum market has been in a surplus. Sometimes those surpluses have been large, and sometimes they've been small. Last year, the surplus fell sharply from something north of 200,000 ounces by our estimate to around 44,000 ounces. That reflected lower production in South Africa and several other countries, and it also represented an increase in fabrication demand in jewelry and in some other applications. You can see that in that period, 1985 through 1992, there were large surpluses, and those were absorbed by the mining industry and the refining industry at a time of relatively weak demand. And that was reflected in the platinum price being relatively low throughout that period of time. Platinum price peaked, I believe, in 1986 and was weak into around 2000, 2002. Started rising after that. That second period of large surpluses from 2003 through 2011 or so. That represents platinum that was bought by investors. And that drove the price higher. The price of platinum was around $300 to $500 in 2000, and it got as high as 2,000 some odd dollars in early 2008 when there were supply disruptions in South Africa. That big red bar in 2014, I should mention now because it comes up in future slides, that represents a 6-month strike that the South African platinum producers took in early 2014. They were trying to break a union that was attached to the EFF, which is a communist political party in South Africa. And they took a large strike, which cost more than 1 million ounces of production losses during that period of time. And you had that deficit. Interestingly, and if you could look at it, price chart and see it, the price of platinum didn't rise. And that was very important for a variety of reasons. Now, this is other people's data on supply-demand balances compared to CPMs. The CPM data is the blue bars, and the green stuff is the data published by the WPI, the World Platinum Investment Council. It used to have SFA, Oxford, produce it, and now they've switched over to a different company to produce their data. And they show large deficits. And to be fair, they show large surpluses from 2018 through 2022 as well, as we do. Much larger surpluses than we have, in fact. Their data seems to be much more volatile in terms of year-to-year changes in supply and demand than CPM Group's data. But you can see that they had deficits in the previous years. As the platinum price fell, you saw the blue line is the annual average platinum price. The platinum price fell from around $1,600 an ounce in 2012 to $800 in 2014, 2015. And as that happened, they had large deficits that they were protecting. We were saying, well, with the exclusion of the 2014 strike, the market was in surplus and there was a lot of metal around to meet that demand, even in the face of the strike. And I'll show you that in a second. So we exclude investment demand from our supply-demand balance. That's how most commodity market research does. You look at supply versus fabrication or consumption demand, and you don't necessarily factor in investment demand because investors don't use or consume a commodity. They keep it in refined form, readily saleable back into the market should they decide that they no longer want to own platinum or other commodities as an investment. So we look at it as a supply-demand, fabrication-demand balance. Other people throw in estimates of investment demand and come up with large deficits. And then they're surprised that the price of platinum doesn't rise. If you take out investment demand from their data, you still see deficits, but much smaller deficits over the last 3 years. Just that kind of data is what has caused a lot of investors to be confounded by the inability of platinum prices to rise. Using our data, the inability of platinum prices to rise makes total sense. Now, these are above ground inventories, and we supplied this data to the World Platinum Investment Council when it was being formed in 2014. I'll go into that in a second. But we're relatively comfortable. You'll see that our data, I started developing this data series on PGMs in 1979, and we took data back to 1976, and we had an estimate that there was probably more than 4 million ounces of platinum in refined inventories in 1975, much of which was in the Soviet Union, which had a surfeit of platinum and had built up those inventories, which were sold off in the period 1992 to 1997. But you can see big increase in above ground inventories, again in the late 80s or the early 90s, absorbed by the South African platinum industry at the time. Then it was pretty much flat for about a decade. It started rising around 2000, 2002. And we saw our estimate of above ground inventories rise from about 8 million ounces to around 13 million ounces in the period from 2002 to 2010. Kind of moved sideways, and then it declined from 2011 into 2014, not 2024. It's been rising ever since that time. And a big part of that rise, again, appears to be investors. Now, we happen to know that a lot of this metal went into investment. And we know that because we were advising the investors who were buying it. And we were advising the investors who were selling it. So if you look at that period, 2000 to 2007, you saw that investors began buying increased volumes of platinum. And a lot of that was stored as sponge in Zurich. That surprised the market. Our advice to our clients was to store it in sponge or powder form in Zurich so that it was readily available and it was in the form that fabricators wanted. Fabricators don't want bars. They want, well, maybe some do, but most fabricators prefer sponge or powder. And so by storing it in sponge form, you get into a situation where in two of the three scenarios that you can imagine, you have metal that you could sell at a better premium than if it's in ingot form. Our estimate is that investors bought between 3 and 5 million ounces of platinum in that period. During that period, in 2000, 2001, and 2002, CPM Group issued intermediate-term platinum buy recommendations 3 different times over that period of time. And, fair disclosure, we were working with the Platinum Guild International, which is a group, at that time it was mostly South African platinum producers supporting that. And they had created for a while a platinum investment demand operation that worked with us and the U.S. Mint in creating the Platinum Eagle coin in the mid to late 1990s. And we actually were working with them on other things to stimulate investment demand. And when we came out with those recommendations, they circulated. In 2012, the platinum industry was starting to worry because the price had risen. They were not seeing strong investment demand. They were worried about some issues with long-term fabrication demand. We had gone through the Great Recession where you had seen a sharp decline in fabrication demand for a while. And CPM Group in that environment, we produced an open letter to the South African platinum industry suggesting that they really needed to support investment demand and promote investment demand. If you want a higher price, you want investors buying your metal because fabricators, generally speaking, don't buy into rising markets. They try to use less metal as the price rises, but investors will chase the price higher. And we initially produced this as a memo for one of the South African producers that was a client of ours. And then he asked us to make it a more generic, the CEO of the company asked us to make it a more generic letter that could be distributed throughout the South African platinum industry. And we have posted that on our website. Here's a link. You can go back to our market commentaries from 2012, and you can find that letter in which we were saying, look, if you really want to see higher prices, as you saw from 2000 to 2007, you need to stimulate investment demand. And it's also the cheapest and fastest way to increase the demand for metal compared to trying to come up with new uses for the metal. Between 2012 and 2014, investors were selling at least 1 million ounces of platinum. Now, in 2014, as I said earlier, the South African platinum industry took a 6-month strike. They had a lot of inventories that they had built up, some of which was in Zurich in sponge form, and there was other metal there too. And so they were able to supply their fabricating industry users, customers, with metal during that strike. The platinum price flatlined in that 6-month period in the first half of 2014, leading South African mining executives and others to say, if the price is flatlining during the biggest strike in the history of South African platinum mining, at a time of increased saber rattling between the United States government and Russia, what happens when the price when the strike is settled? Right? And in that environment, we got a call from a representative of the South African mining industry saying, hey, your letter from 2012, we didn't throw it away. We set it aside. So we've seen some insights there from investors and from others that help us know that our analysis of all of this goes pretty well. Looking at the other three metals, August COMEX, today was a very strange day because COMEX fell. It's off $44 as we speak. It was, when I started this presentation, $3,349.40. It is now $3,331 today, right now. Gold fell sharply, and platinum, palladium, and silver rose sharply. Not quite sure why. Our belief is that a lot of it was technically inspired by price patterns. The silver price has been rising and took out some important buy signs, price levers, including $35 and $36. Platinum, and palladium also took out technical buy levels. And we think that what you saw today was pretty much technically inspired. Gold, on the other hand, had risen sharply last week and was trading above 3,400, close to record level price levels. And you saw some profit taking today. The political and economic environment is a real mess, and it's causing a lot of uncertainty. So you've got this broken field where gold fell and silver, platinum, palladium rose. Silver, as I said, rose. It was $36.87 when I started this video. And you can see, yes, it broke above $34. Then just last week alone, it broke above $34. Then it broke above $35. And then it broke above $36. And today it was trading as high as $36.87. Actually, the high, was $36.87. And then palladium also rose sharply. And again, you can see it took out some technical support levels around $1,025, having been trading below that since March of this year. So we think that what we're looking at with the strength in platinum, palladium, and silver, part of it is the fact that the July contract is an active contract for silver and for platinum. And you have shorts that will be buying back their July contracts and rolling them forward over the course of this month, which could support somewhat higher prices. There's also been this optimism about jewelry demand in China and auto demand for platinum and palladium. We are very cautious about that because we have a kind of pessimistic view for the economy over the next 12 to 18 months. So our expectation is that the price could continue to be volatile, but that it may be that we see some weakness beyond June. So once we get into July, maybe you'll see some of these prices come off. But that means that you still have half of a month, more than half of the June, to see stronger prices, at least on a temporary basis. I will be covering silver again, I hope. Well, unless the market demands that I talk about something other than silver, my view is to come back and touch on some issues in silver in our Friday video. In the meantime, you can go to our website. You can buy our gold and silver yearbooks for 2025. They're out and they're downloadable as ebooks. You can pre-order our Platinum Group Metals yearbook. You can send us a note at info@cpmgroup.com. You can sign up as for our retail investor program or other services that we have. Take care of yourself. Take care of those around you. Be careful if you live in LA or San Francisco or probably any other major city in the United States. And it's not particularly safe in major cities in other parts of the world right now. So take care of yourself and those around you and try to do something good for the world. We all need it. I'll talk to you on Friday.